This video, as part of the compilation on money management, is all about taxes. And if you're in business and you're making profit, you'll pay tax. Even if you're not making profit, depending on the type of business you're in, you'll be paying some form of tax, usually known as VAT and PAYE if you have employees. And it's one that I see people struggle with a lot. And you might or you might not know, I have my own accountancy practice, so we help lots of clients with their accounts and also managing tax. And quite often for clients and business owners, it seems to be a bit of a struggle at the end of the quarter when they have to pay their VAT to try and find those funds. And for others, obviously, when it comes to paying their income tax in terms of self-assessment by the 31st of January or the end of July, and also paying their corporation tax, there usually isn't any money in the pot because they've spent it, and usually they've either spent it on themselves or they've invested it in their business. So the first thing I'd start off by saying is it's very important in my view that for you to have a different sub-account, and that sub-account can either be for just one for VAT, one for corporation tax, one for personal tax. But if you're the type of person who doesn't like too many sub-accounts, and if you saw my first video on budgeting, I already talked about having separate sub-accounts for your personal life and your business. You might feel you've got way too many sub-accounts, and a sub-account, by the way, basically is just an additional account linked to your main account. So if you don't want to have too many sub-accounts, have one just called taxes, and then every time you have money coming in, or worst case scenario, every month, transfer all of your VAT that comes in into that account. So it's ring fenced, it's not your money, you can't spend it, it has to go to HMRC, Her Majesty's Revenue and Customs. So that therefore the money's there ring fenced for you to pay out, depending on whether you're on monthly or quarterly VAT returns. Now with that, I would say do the same for your corporation tax and your personal tax and PAYE, so that when you keep transferring money there, it's going to keep you focused on exactly how much have I got left over. Sometimes it creates a false economy, because what people do is they save up their VAT and then when it comes time to pay it every quarter, they think they've got, let's say, £50,000 extra in their bank account. Really, it's not extra, that's their VAT liability for the quarter. But because they've not been separating it, they've been merrily spending it away, and then they go to their accountant, and their accountant says, here's your VAT bill, it's £50,000. Lo and behold, they haven't got the 50 grand, they've either spent all of it or they've spent some of it. Whereas if you ring fence it and put it into the sub account, the money is there, you'll just make the payment because you know it's not your money. And the clients who I've worked with who've done this, it's helped them a lot, it's made it easier for them, it's less painful because once you've ring fenced it, you know it's not your money, it needs to go to HMRC, there's less pain of paying those funds over, and it helps them to become more disciplined. They can then see how much real cash flow they've got left. And then they can then decide on, do I have enough working capital, do I have enough funds for running my business, do I have enough in my reserves, and do we need more money for sales, marketing and the other activities. So just to remind you, the main taxes and the ones that you ought to be thinking about is you've got VAT, you've got corporation tax if you're a limited company, if you're a sole trader partnership or an LLP, then you've got income tax. With income tax, you've got also national insurance, which you'll have to pay. So those are your main taxes that you need to be aware of. If you employ people, they pay tax to the PAYE system, pay as you earn, and then you pay your employers national insurance on top of that. So that's something that you'll obviously need to account for. And then going a bit wider, things like estate planning, you should be thinking about your inheritance tax exposure. Worst case, once a year, sit down with your advisor and look at, okay, how much am I worth now? What's my exposure to inheritance tax? And can I do anything in terms of planning towards that? And then obviously there's wider taxes, like you've got to pay business rates. If you have premises, you'll have to pay council tax for your own home, and then all the other taxes. But I'm not going to say you have an account, sub-account for all of those different taxes, because otherwise you'll be spending all of your day pretty much managing those different accounts. But it's well worth looking at having a sub account for your taxes, and with that I'd also say it's important for you to review the taxes you pay to make sure if you can become more efficient, because there's lots of different reliefs, allowances, exemptions that a lot of business owners aren't aware of. Sometimes accountants kind of fall short in advising their clients about all the different reliefs, and it's difficult to go back and claim something after the event. So before you do something, before you buy something, talk to your accountant and your tax advisor, ask them, because when you have that conversation with them, that's when they can best advise you on how to enter into a particular transaction, and then they'll also be able to share with you and remind you of the different tax reliefs. And if you do that on a regular basis by having like a pre-year-end tax meeting, usually between 4 to 8 weeks before your year-end. Some people like to have it a quarter before their year-end, and then have a post-year-end meeting. So this is after you've prepared your after your accounting year-end. So ideally 3 months after your accounting year-end. I know that's not always possible, it could be 4 or 5 or 6 months, but the sooner you do it the better. And then you have that meeting and go through what taxes you need to pay, but also plan for the next year. And the reason why I say do it as soon as you can after your year end is because things will be fresh in your mind, where you can answer questions. But also if your accounts are prepared 2 or 3 months after your year end, and let's say you're a limited company, you've then got 6 or 7 months to pay the corporation tax. Whereas if you prepare the accounts in month 8 or 8.5, then you've only got 2 to 4 weeks to pay your corporation tax. And if you don't have a separate ring-fenced account for your taxes, you're going to struggle to find those funds. So a pre-year and a post-year tax meeting is important to help you keep on top of your taxes. So that's tax for you. The one thing you need to take away is have a sub account and put all your taxes there. If you're interested in budgeting, financing, investing, there's other videos that I've shared in this series. Please check them out. Click the like button if you like this video. Also subscribe so we can update you with regular content. Above and beyond that, post any comments you like on any questions you have on any of the taxes I've covered, but also any comments on the kind of content you want, because if I know what you want, then I'll try my best to deliver that type of content to you so I can add the most value